All right, we're trying to finish up chapter 6 with this video here. Uh, Business investigation and pre-opening expenses, section 195 allows current deduction for startup expenses in the year the business starts. And that deduction is the lesser of actual amounts spent or $5,000 if it phase out for amounts over 50. And the rest you got to capitalize and amortize over 180 months, starting in the month the new business begins. Timeline for investigation and pre-opening expenses. You got to incur it. You got to make decisions to make the purchases. You got pre-opening, business opened. That's when you start getting into the necessary or expenses. I'm going to go over this slide because we've kind of already gone over it. When expenses are deductible under the cash method. General rule, you deduct it when it's paid. Exceptions for prepaid expenses and prepaid interest expenses, but generally with cash, it's I recognize income once I physically receive it or constructively receive it, and I recognize expenses when I actually pay out the money for it. Generally, prepaid expenses are not deductible when paid. That's because I'm paying for a future use. There's an exception to that prepaid rent can be deducted when paid if the cover of prepayment is less than a year or is required by the lease. And for prepaid interest, generally, the taxpayer can only deduct over a period of time to which interest expense relates. The taxpayer receives a discounted note, they only need to recognize interest income when the maturity value of the note. Exception points can be deducted if four requirements are met. The amount is specified as points in agreement. Points are a percentage of the loan. Points are an established business practice in that region and paid to purchase principal residence, which secures the loan. I don't see a lot of point deduction in what I do. It's not super common, but here are the rules for it. Prepaid interest under the cash basis, points paid by the seller are treated as if the purchaser paid them. Taxpayer refinances the mortgage, points are not immediately deductible, but you got to amortize it. And unamortized points can be deducted when the taxpayer terminates the loan by then refinancing the sale. And that gets reported on your Schedule A, meaning it's a deduction from accrual method. Taxpayer can deduct amounts paid if both criteria are met. The all events test, which I think we covered in a previous one, and then the economic performance. So all events test, two requirements. You have to establish that the liability exists and the amount of liability is determined with reasonable accuracy. This is a law that I frequently have to think about is have we established that the liability exists? And as of a certain date, can you reasonably determine what that liability is? Exception to economic performance, you got to meet all of these criteria. You got to do the all events test. The economic performance occurs within 8.5 months after the close of the tax year. That's a very popular law. The expense is recurring and the taxpayer treats as incurred during the tax year and not material, and you can't really match it better. Then it's going to say, yep, you meet all these tests. This is an allowable deduction. Wash sales, section 1091. If there's any of you that fancy yourselves day traders out there and you don't know about wash sales, you might want to pay attention. Generally, losses on the sale of stocks or securities are disallowed in the year of the sale if the taxpayer realizes a loss of the sale and acquires a substantially identical. That's the wording on it. No one's really sure as to what that entails, but is Apple substantially identical to Facebook stock? Is Tesla substantially identical to Ford stock? That's not particularly clear. So my general comment on it is if you're going to close out of a stock, really close out of it because wash sales can come back to bite you. Acquire substantially identical stock or securities within a 61-day period extends from 30 days before and after the sale. Exceptions, dealers may recognize losses or intent not to generate an artificial tax loss. going back to this wash sale, I've seen people trade stock and then trade back out of it and then buy back into it, and they keep doing that. And this disallowed loss keeps growing. So you don't recognize the loss, so you're recognizing this income. And I mean, I've seen people where their 1099 shows that they made $1 million in capital gains, and a wash sale disallowed of $1,100,000. So how that plays out is that this taxpayer has to recognize this $1 million of income in the year that it happened, which you probably don't have the money to pay taxes on it. And then the next year, that loss is allowed. So we're going to say $1,100,000. And assuming that they don't have any other capital gain income, they can only recognize $3,000 of that per year. Meaning, we're pull up our calculator here. We're saying they had $100 million in losses, and they can only deduct $3,000 losses a year. Meaning it would take them almost 367 years to fully recognize that loss. This is why wash sales are so important to kind of wrap your head around. It's that you don't get to recognize a loss if you sell a stock and then buy back into it until you completely clear out of that stock purchase. To do that, you basically have to sell it and wait the 30 days. Related party disallowed losses. Original seller receives no tax deduction. The purchaser's basis is equal to the amount paid, which is how that generally works. And upon later sale of property, purchaser may decrease recognized gain by the disallowed loss. And if the disallowed loss is greater than the gain, then that loss disappears. And here's who a related party would be. So you have the taxpayer, it's siblings, it's half siblings, it's your spouse, ancestors, lineal descendants. So it covers most of your family. Other related party, an individual owns greater than 50% of the value of the corporation's outstanding stock. Grantors, beneficiaries, and fiduciaries of a trust. Corporation, partnership, if each owns greater than 50% of each other. Between two corporations where one of them's an S corp and one person owns greater than 50% of both. They are now related parties. They have this individual who owns greater than half of each business entity they're related. Attribution rules: stock owned by family deemed owned by an individual. A partner who owns stock in a corporation is attributed stock owned by a partner. And stock owned by an entity deemed proportionally owned by shareholders, partners, and beneficiaries. And here we've got an example. Craig and Alice are married. Alice is attributed Craig's 30% of first. Alice is not attributed to Beth's first stock. So if Alice sells the property at a loss at first, she's going to be able to recognize it. Craig doesn't own more than. I'm not going to go back into this, but it's just it. Hobby losses. The taxpayer is presumed to have a profit motive, and he or she can show a profit for 3 out of 5 consecutive years. The IRS then will have a burden of proof to disprove the taxpayer's position. If an activity is considered a hobby, the taxpayer can deduct expenses only up to the amount of gross income. So I can't really ever report a loss on hobby income. I can net out to 0, but other than that, I can only recognize income. I don't get to recognize a loss. Vacation homes, property is equal to the residence if the taxpayer's personal use exceeds the greater of the following: 14 days. Often what I end up saying is the 14. And 10% of the number of days property is rented at fair market value. Personal residence versus the rental unit, the amount of deductions may be restricted under Section 280. So here you've got 3 categories: primarily personal, you rent it for less than 15 days. Mixed, you rent it for greater than 15 days. Personal use exceeding larger of 14 days or 10% rented days. Primarily rented, you rent it for days. Vacation homes, tax impact, so primarily personal. You may exclude from gross income the rental income received, but you can't deduct expenses related to the home other than the itemized deductions for some purposes or for property taxes. Mixed personal and rental, taxpayer must report your gross income of the rental income, and then you can offset it with some rental expenses. But you can't recognize a loss, similar to HUD. The losses are carried forward and they're going to be deductible against the subsequent year's income. And primarily rental, taxpayer must report gross income, all of the rental income, and may offset all allocated rental expenses against that income. There you can recognize a loss. You don't have to carry forward the losses. Personal use of property includes taxpayer's family uses the property for personal use unless you charge fair market value rent. Property is being used under reciprocal use arrangement, and any day fair market value rent is not charged. So basically, you got to treat it like it's a rental. If you're, I couldn't let my sister stay at my home and not charge her rent. It would be personal property. Vacation home allocation of expenses. You got to allocate between personal and rental use, and that's where that 14 days comes into play. If you have personal usage greater than 14 days, then you deduct expenses only up to gross rental income Schedule E, and losses are carried over. And then if personal usage is less than the 14 days, then deductions are still allocated, but they're not. Then the rare rental use expenses, you multiply that by the number of rental days divided by the total number of days. Okay, and that covers week 6. We're going to move to deductions and losses. I feel like it's fairly straightforward. Some of the cash versus accrual stuff gets to be a little weird, and then you get into related party and then rental income, vacation homes. But generally, if you have some personal use of an item, it's going to generally be deductible in some capacity. You might have to allocate that personal use percentage, but that's generally the rule. You don't get to recognize an expense or a loss on something that is personally held. Okay, that covers it for lectures for week 6. All right, thanks everyone.